Hey there, Lincoln here from bullacademy.org. Today I want to walk you through a video by Felix and friends and just respond to what we're hearing from Felix, a stock market investor who has an opinion on SoFi IPOE. Excuse me, as I set up here real quick, but we're going to walk through this video. It's about 27 minutes long, and Felix has ideas on SoFi IPOE, the SPAC taking SoFi public, and I want to walk through my thoughts on his thoughts and whether or not he's correct or if he's completely wrong. I didn't want to have to do this, but I feel like there's been a disservice done to investors in this video. I didn't want to have to put down another YouTuber, but this is just how it is. There's been some thoughts in here. I came in looking to be, fair and hopefully find some new ideas about what I missed in SoFi as an investment. But in this video, I didn't really see too much in way of really correct and reasonable arguments against IPOE SoFi as an investment. Of course, I am a biased person. I have 4,000 shares of SoFi or IPOE, but I like to always know what I'm missing, what the other opinions are out there, what the arguments against my investments are, right? I look for this myself. But tonight, a patron of the channel brought this video to me and said, hey, Lincoln, check out this bearish review of IPOE SoFi. Let me know what you think. So, of course, as a patron, he deserves my thoughts on it. So I watched it. I have my own thoughts on it. I shared it with the group, with the community in our Discord channel at patreon.bullacademy.org. And they all got to see what my thoughts were. But now I wanted to come out because I just felt like I needed to come out and let you all know what my thoughts are immediately, because I saw someone on this video comment that they're selling all their shares in IPOE SoFi because of this video. And I don't agree with that. If you're going to make an investment decision, do your own research and make sure that you're thinking about the long-term potential of the companies you're investing in. And don't just take whatever some YouTuber says, or even me, right? I'm a YouTuber too. Don't just take what I say and just run with it. So we're going to walk through this video. We're going to watch this video in full, 27 minutes long, and I'm going to break down each part that I think is meaningful to talk through and let you know how I think about it and why I agree or disagree. So I hope you enjoy it. Felix, if you're watching, Felix and friends, I didn't want to have to do this, just to be clear. I don't like to put down the YouTubers and I don't like to do response videos, but I figured it's a service to my community, my audience. So I hope that you all enjoy it. And Felix, I would love to have you on the channel at any time. You obviously have more subscribers than me, so I know I'm going to get some hate from your audience, but I do invite you on if you want to respond to me. Let's talk about it and let's hop into this video. So I have downloaded the links down in the video description below. So if you want to watch it yourself, go ahead, but we're going to watch it. We're going to watch it right now. So let me get this ready for you all. Stay in there. If you enjoyed the video, don't forget to like and subscribe, comment your thoughts. Let me know if you invest in IPOE, SoFi, and of course, join us over at patreon.bullacademy.org to support the channel, reach more investors, get more access to me, discuss the stock market in real time, and all of that, right? Communicate and collaborate on new investment ideas. That's how we found IPOE, SBE, and so many other deals before everyone else did, including CCIV, Lucid Motors. So let me switch over to live picture-in-picture, and we're gonna walk through some of this video. So let's do this. So one more reason as to why I'm doing this live. I could have gone through and watched this video myself and share with you all my thoughts, recorded it, and then edited it and then put it out. But the reason I'm not doing that is because I want to be clear that everyone makes mistakes, right? Felix is just human. I'm just human. We're going to make mistakes. But I want you to see for yourself that I'm not editing my responses here. This is my response live so that you can understand that, yes, I will make mistakes, but I'm going to correct it and not be afraid to get things wrong. And when I do get them wrong, I'm going to let you know why I got it wrong and what the correct response is. But what I don't like is people getting things wrong and then publishing it for other investors out there to make decisions off of. So that's why we're doing this live. But let's hop in now. So Let's go.
Felix here, guys, and we are going to analyze and take apart the SoFi IPO next week, and we're going to look at really in detail.
Let me know if you can hear this. If you can, let me know if there's any problems. Of course, comment in the live chat. We'll get to those as well. I love when you guys respond. It's always fun to be engaging. So let me know what your thoughts are as we watch this in the live chats below or to the right, wherever it is on your screen. So let's keep going. This is Felix.
What do they do? How are they disrupting banking? What are the services? What is in the investor deck? What are the margins? We're going to compare it to other companies in this space and then form an opinion as to whether or not this is a good investment, guys. So stick around. If you only want to know my conclusion, jump forward to the end. But I think you missed the whole process, in which I think you can also learn something, because you can apply that to absolutely everything as well. So SoFi is brought to me by, and I should show you this, guys. First, I should, as always, say this is not financial advice. This is just for entertainment only. And I should say a big thank you to one of our lovely community members, one of our patrons, Lithium Iron Bot, who actually started this discussion over on our fintech channel, on our
This part isn't too long. Let's just watch it just so we can go all the way through. I don't want to skip any parts, so bear with it. Let's keep going.
And you can get there, guys, through the Patreon link below. There are still a few of the special offer tiers available, so check that out. And as always, I like to respond to our community, what they're interested in, and a lot of them were asking, is this a good buy or not? What do you think, Felix? So I'm going to show you exactly what I think about that. And the first place we're going to start is by looking, what is it actually? Well, it's an online bank for what are now called Henrys, high income, not yet rich, youngish sort of people. So college educated people with relatively good jobs, have good income levels, but they probably still have some debt, college debt. They might have home loan debts. Homing alone seems to be a difficult word for me to utter today. And that is kind of a good segment to be in, because these are people who are affluent now and they are rising in their sort of wealth space. So they will have more money down the road. So if you can make them stick with you, it's a good sector. It's essentially an online bank. Now, what do they offer? Well, you can see here, this is their website. Credit card is new. They're offering student loan, refinancing home loans, investing, sort of brokerage type stuff, a little bit like Webull, personal loans, insurance, business financing.
So he's just explaining what SoFi is. If you haven't seen my videos on SoFi, I've covered them in many videos. We've done so many videos on SoFi. Actually, this weekend, I published a video on their Q1 earnings, which is the video right here. And you should go watch that. I break down the entire Q1 of 2021 earnings and how IPOE SoFi continues to grow. So if you don't know what SoFi is, go watch that video. Go watch my previous videos on that. But let's keep watching what Felix has to say here.
Loans, all that sort of stuff. So really, if you look at this, okay, it looks a lot snazzier. It's got an app, but it's basically what most banks will offer, right? So far, not the greatest revolutionary idea, but why is it different? Because it's an online, it's sort of a virtual bank in a sense, as in they haven't got all that overhead of all those branches. So therefore, are they the big disruptor? Well, we are going to look at the actual numbers. We're going to look at the business model. And this is precisely what I teach in my course, guys, how to really look and understand a business and learn to read the income statements and not be sort of befuddled by.
I'll let Felix sell you his course, but I just want to say he's right. SoFi is not very special in that it is a bank. It's online. They save money because they don't have any physical locations. And they do a whole lot of things. And what makes them special is that they're a one-stop shop. I think that's what Felix misses in this whole video. They are a one-stop shop. And the key here is vertical integration of centralized services. Remember that. Vertical integration of centralized services. That's going to be very important. And I've covered this in my previous video. So if you haven't seen that, go watch it. It's extremely important. I don't think Felix understands that, but we'll get to it later. Let's keep watching.
flash presentations and nice promises. It's to understand that. So again, guys, the link for that is below. There is a coupon code which is freedom, and that means big, fat, juicy financial freedom. So check that out below, guys. 39% off, and that lasts another 3 days. So honey, now, what are their services? As we just looked at them here. But let's have a look at the actual numbers here. And I'm a numbers guy, and I know not everybody likes to read things, but I think it really is a good idea. If you're going to invest into something, you have to understand the numbers. And the key numbers are here, that their student loan, personal loan, and home loan business is basically their core business. So you can see here, and let me magnify that a little bit for you. Oh, no, I can't magnify it, but I can zoom in for you here. So the top three here are loans, and you can see those together are total originations of loans, 8.8 million. Is that in thousands? 8.8 billion, that makes more sense, in the last 12 months. And then they have a little bit of other stuff here. Their technology platforms brings in a little bit of revenue, but nothing really to write home about. And
okay, guys, so this is the first point where I just start going a little crazy, because he just said that Galileo, SoFi's technology platform that brings in about 20% of their revenues, is nothing to write home about. 20% of revenues, imagine having 5 sources of income, right? That's 20%. One of them is 20% of your income. So if you lose 20% of your income, that's a pretty big deal. So him saying 20% of the income is nothing to write about, nothing to write home about, that's not very credible, but let's keep watching.
If you look then at the next page here, you can see that their net revenue comes almost entirely from lending. So you can see here the net revenue was non-GAAP 621 million US dollars, millions that is. The others were the loan amounts, and of that 536 million is lending. So this is a lending company, right? The brokerage and all that stuff in the app, it's all very nice and fluffy, but this is a loan company. They loan.
Yes, Felix is right. Felix is completely right. SoFi is largely make their money from lending products. But what he's missing by calling the other financial services products fluff is the vertical integration of centralized services part of the business. That's what makes SoFi special, and he's completely missing that. So how do you make money as a business? You have to go out, produce a product, and then sell it, right? Market it to people, tell them why it's good, show them how credible you are, why they should trust you, and why they should borrow money from you, right? So all of that comes with a cost, that marketing cost. So SoFi has found a way to lower their marketing costs by presenting their customers with all the services that they need under one house, by vertically integrating centralized services. So when they want to go sell a lending product, a loan, a student loan, a home mortgage, and so forth, they already have their customers right there in their app. All they have to do is send them a notification and say, hey, we see that you have all that money sitting in your bank account. Why don't you buy a house? And here's a loan for you. Here's a credit card, so forth, right? And they make their money from that lending product that they sell to their customer. But the beauty of all of this is that they decrease their marketing cost, the cost of marketing, which means that the cost of revenue goes down over time, which means more profit over time. So no, the financial services may not bring in as much money as the lending products, but they bring in the customers. They keep the customers around. They increase the lifetime value of SoFi's customers, their members. That's a very important part of the business. And to miss that shows that you don't understand the business at all, or just simple centralization and vertical integration. These are simple, not simple, but these are basic ideas that people know are valuable. Vertical integration and then centralization. Put them both together and you have a win-win for the business and the customers. It's not fluff. We'll get into it more later. Let's listen to what Felix has to say, and keep commenting. And in the live chat, I'll get to you guys soon. Nate and Noah, I see you. Thanks for commenting. Thanks for engaging. Let's keep going.
money for student loans. I think that's really where they started, and home loans and all sorts of other loans. That's really what they do. The tech platform is, less than 20% of revenue. The financial services are basically irrelevant at this point. So that's what this is. So don't get
10% of your income is irrelevant. 10% is okay. That's fine.
confused by all these lovely, wonderful things. It is a loan company. They lend you stuff, and for that they make money, and they probably do that, well, possibly do that more efficiently than a big bank would. But whether or not they do, we need to basically discern that. Now, one thing that jumps out at me.
Sorry, I have to comment on this. Those things that he just said were confusing. All their products, they're not confusing. That's the product. The reason they're so popular is because they have a one-stop shop. I can do my banking. I save money. I invest money on SoFi, right? Through their investing arm. I see all of my finances through Relay. I refinance my car loan through SoFi refinancing. Student loans, SoFi. Home mortgage, SoFi. And you know what? 65% of their customers for their home mortgage product comes from within their app. That's the value of vertical integration, of centralized services. They don't have to market to 65% of their customers. That's free money. That's not fluff. That's how you decrease the cost of revenue over time. And this is a theme of SoFi. That's why this is why I think that Felix, just not understanding that derailed Felix and anyone else's analysis of SoFi if they don't understand that basic part of the business. And I say basic, but it's fundamental to the business. So if you don't understand that, you misunderstand the entire business. And that's the sad part here. So this whole video is going to be on the same thing. I'm going to have to keep saying this because that's the whole company, vertical integration of centralized services. And you see the value of it if you look at the numbers. So let's get to the numbers, and we'll see what Felix has to say on that.
Immediately is always look at growth numbers. So we look at 2020 to now, and you have there something like a 16% growth number or so. And that's not the greatest number. I would have expected that to be a lot more. This is the pandemic year. There's been a huge transition from offline to online.
So he's saying here that 2020 number, $621 million in 2020, all of 2020, versus the LTM. Guess what LTM stands for? Last 12 months. From when? From the end of Q1 2021. So the last 12 months from there. Well, that happens to include 3 quarters of 2020. So he's comparing 2020 to the last 12 months ending in, March 2021. And he's saying that that's not enough growth, 20% growth over that between 2020 and the last 3 quarters of 2020, plus the first 3 quarters or first 3 months of 2021 is not enough. So what's happening here is that he's misunderstanding or mistaken. Of course, I think he made a mistake here. He's mistaken LTM for the end of the year 2021, but LTM means last 12 months. So he's comparing apples and oranges here. So 20% over the last 12 months over 2020 versus the last 3 quarters of 2020 plus the first 3 months of 2021 is not bad at all. So he's completely misunderstanding what LTM means, and he's comparing that to 2020 as if it's 2021's numbers. But 2021 isn't. This is the first quarter of 2021. 2021 just started. Yeah, it's only 20% because we're only 1/4 of the way through the whole year. So of course that's not going to be a bigger number. So he predicates his entire argument, his entire analysis of SoFi IPOE on this mistake, and you will see him do it again later on. This mistake derails his entire analysis. And he doesn't even take the time to understand that. And later on, you'll see that he notices that his math was messed up, but because of this mistake, but he keeps going with it. So watch out for that, and let's keep going. So yeah, the math numbers are great, but you have to understand them, right? So let's keep going.
You would have thought that a company that's entirely online without physical branches would have really benefited from that. But instead, they've kind of replicated the growth in previous years. So little bit of a caution.
He's thinking that SoFi is growing at only 20% per year based on his erroneous comparison of 2020's numbers to last 12 months numbers. And he's taken that as his basis for SoFi's growth numbers, which is completely erroneous. It's completely wrong. So, and SoFi is growing at 25 to 44% per year. So the numbers are in the presentation for him. He's not even looking at them. They're given to you, and he's using wrong numbers. His entire analysis is based on his error. So that tells you what you gotta know. If you want to keep watching, go ahead. But if you don't, I don't blame you. But let's keep watching.
Flag there, not anything that decides whether or not I'm gonna invest in this sort of reverse SPAC IPO. And I should mention that, of course, guys, they're going to list through the IPOE SPAC, and we're going to look at the charts and everything in a moment as well. So it's this.
IPOE is a special purpose acquisition company that's taken SoFi public. If you don't know what SPAC is, go check out my previous videos on SPACs and SPAC warrants. We have the best video, according to Google, on SPAC warrants. So if you haven't seen that, you don't understand what SPACs are, SPAC warrants, go check those out.
First merger thing. And I mean, some people love SPACs, some people hate SPACs. I think it doesn't matter. Great companies and terrible companies have gone to market for using a SPAC. So the method is secondary to me. To me, all that matters is it a good business? Now, let's have a quick look then at the investor deck here. And we wanted to start a little bit higher up, so I can show you some of the stuff here. Okay, so lots of fluffy stuff up here, pretty pictures, pretty girl wearing trendy things. None of that really matters, you know, circles and all this stuff. Okay, very nice. They basically want to get people who give them, originally take a loan from them, maybe a student loan. They want them to also do their other investments, their credit cards. They want them to do absolutely everything.
That's only half true. So what he said about them SoFi wanting their loan customers to use the entire ecosystem, their investing, their money, their relay, and all of that, their credit cards, that's true. But what he's missing is that what's more important is the other way around. They want the people using their money, SoFi money banking service, their investing service, their credit card, their relay, and all of that. They want those people using those cheap products that barely make SoFi money. They want them to stay in the ecosystem for long enough for them to upsell them on their mortgages, on their car loan refinance, on their student loan refinance, right? Later on, to make them actual bank customers. So he's mistaken the actual goal of this flywheel. And what we're seeing here, this is called Flywheel. So he's mistaken it for, it's the opposite way around. The goal is to keep customers in, right? And the more they stay in and are satisfied, the more they tell their friends about it. And then their friends come and they get in this ecosystem and they stay in the ecosystem. And then SoFi increases their lifetime value by keeping them for longer because they give them all the services that they need. SoFi is one of the only companies, I don't know of too many others, that are doing this. You get to do all your financial needs in this one app. So when they want to sell you now on a mortgage, they say, hey, we know all your finances. We trust you. You want a credit card? We know your credit score. We trust you, right? We know how much money you have saved. So here's what you can actually afford. That's the flywheel. It's content, convenience, it's fast, and it's selection. That's not fluff. That's called a business model. That's called decreasing the cost of revenue. That's called increasing the lifetime value. That's called decreasing customer acquisition cost. All of this stuff is not just fluff. It might seem like fluff to an untrained eye, someone who's never raised money, never put together an investor presentation. And I've had to do all of this. So all these things are important to investors, including retail and institutional investors. When you go out to raise angel investments, they ask for all this stuff. What's your customer acquisition cost? How do you plan to lower that? How much is your lifetime value of your customers? How do you plan to increase that? And SoFi says, this is how we do it. We increase membership by giving them all the services that they need, and keeping them in our ecosystem, and then upselling them on our products, our loan products. So this is not fluff. Let's keep watching.
Also do their other investments, their credit cards. They want them to do absolutely everything. Now, this chart here, or this slide rather, is something that offends me a little, because the laziest way of selling, and you see this a lot lately, because these companies are selling to retail investors, and they are not really selling to institutions, these SPACs. They're selling to you and me, and they think these guys are maybe a little bit easily led. Dumb would be
So that's also wrong. IPOE has 38 points, so like 40% institutional ownership. So 40% of the float of the outstanding shares of IPOE, the SPAC that's taking SoFi public, is owned by institutional investors. And guess who saw this deck? Those institutional investors. And guess who saw another deck like this? Institutional investors with more details. So this is not just some pretty thing for retail investors already done. This is what other investors see. I just told you, when you go out and raise money for your company, I've done it. You have to go out and raise money for your company. And the way to do that is to make things as simple as possible for investors to understand. Doesn't matter who you are, we're all human. We all want things condensed, right? Information is hard to understand if it's just numbers. So you have to make it very clear for people to see and pattern match and say, hey, we're like Spotify in that we're going to own the entire market. We're going to be the winner takes most. That's the point of this deck, this slide. So it's not all fluff. I agree in a sense that, oh yeah, it dumbs it down, that, oh, you're comparing yourself to Amazon when you're not Amazon, or Facebook when you're not Facebook. But there's a point to this slide to say that all these companies were the winners in their industry, in their market, and they took most of the market. Amazon took a vast majority of the market. So did Facebook, so did DoorDash, Uber, Netflix, LinkedIn. Winner takes most is the point here. It's not, oh, we're Amazon. It's not we're Facebook or LinkedIn. They don't care to be those companies. So that's not even their market. So you have to understand when you're listening to people, what their background is. I've raised money. I've put together these decks. And it's super hard to raise money because their attention span are so low. So you have to make things as simple as possible for investors to understand. Doesn't matter if they're retail or institutional. People want things condensed. So no, it's not just some pretty things for dumb retail investors. I find that insulting.
The way of putting it, if they see Amazon, Facebook, Uber, Spotify, Airbnb, and Netflix on one page, and us, and we say, the winner takes most, opportunity still there, then they're going to jump in on this. This slide is not the least convincing thing you could possibly put out there, because it doesn't say anything, it doesn't show anything, it just puts your brand next to great brands. That doesn't mean you're a great brand or that you aren't. But I think I don't like it. It worries me because it's sort of think, is this a really dumbed down presentation?
Again, you have to know who you're listening to. Has Felix ever raised money? If he had, he would know that this slide is a big win in an investor presentation. When an investor sees this, it's not that big of a deal, right? It's like you fly over. It takes a second. You say winner take most. We're going to do the same thing as these companies in their markets. This is what we're planning to do in our market, and then we're going to move forward and show you later on how we're going to do that. But look how well it worked out for these people who have done it in their markets. We're going to be like them later on, later down the road, once we actually execute. But hey, investor, we can be like these people that you know and have succeeded in a similar strategy. This is how we're going to do it, just like they did it. That's the point. It's not to say we're Facebook or Amazon. It's not to win over some dumb retailer or retail investor. It's to make the point very clear, very quickly. Investors don't have a long time to listen to you drone on. They want to see the points made very quickly and clearly. So that's the point. If you have raised money, you will understand that. So no, that's not, it's not, he's completely incorrect here. I get it. I get the point. It's fluff. It might seem like so if you haven't ever went to raise money, but it's more than that.
Trying to convince retail investors rather than giving us the facts of the business. They're giving us here, well, Amazon. I mean, they're not going to be the...
It's an investor presentation. There's a whole deck. You're stuck on one slide and complaining about it. Come on, Felix. You know there's numbers in this deck. There's whole spreadsheets that we're going to talk about later on and how you react when you see spreadsheets. So no, don't give me that.
Next Amazon, are they all the next Facebook? Let's get real. This is very, very, very unlikely. You know, are they Airbnb? Did they invent that whole sector basically? No. Are they?
No, you're right. Airbnb did not invent the entire sector. Airbnb wasn't even first mover. They weren't anywhere close to first mover. You want to know what they were? They were last movers. They were the last mover. And you know why that's important? Because that's better than being the first mover. The first mover makes lots of mistakes. They screw up. They might be too early and they fade away. And then guess who comes in? The last mover. Airbnb comes in and they take over the entire market because they can see what their competitors, their ancestors did wrong and did right, and then do that better. That's why Peter Thiel says last mover advantage is better than first mover. That's why Google wasn't first. That's why they won, because they saw Yahoo and AOL and all those other search engines did wrong, and then it came in and they were the last mover because they said, hey, we're here now. All those other solutions, they were all wrong. Here's how we're going to do it. And then nothing came after them because they were the last ones, last mover. Facebook, Facebook didn't start social media. That was MySpace and Friendster and all those other guys. And they saw what they all did wrong. And they said, hey, we're here now. We know what they did wrong. We know what they did right. We're going to do it all better. And they were the last ones. No one came after them, right? LinkedIn, they didn't invent their space, the professional online network. They didn't invent that. They saw what everyone else did and then took that and said, hey, we're the last movers. We win. That's it. So this point is incorrect too. Let's keep going.
Netflix, are they the first streaming company ready to go mainstream? No, they're not. Are they LinkedIn? Is every professional in the world on it? Unlikely. Anyway, enough of my rant here. But this kind of stuff, it's slight warning sign to me here. But you know, let's look back at the numbers. Let's see what it's all about. So we have here then, nice little slides. Here's the team. They come from, you know, Goldman's, Amazon, TPG, all this sort of stuff. Very nice. Okay.
Okay, so he's talking about the team like it's nothing. Sorry, let's go to that real quick because I wanna make a point here. When you're investing, Warren Buffett said this: I find great management, great leadership. I invest in them, and then I let them do what they've been doing. I get out of the way because they're the ones who know the business. So what I'm looking for, first and foremost, are great management, great managers, leaders. So I want to know who's running the business. It's not just, they're just fancy people from Twitter and NFL and Goldman Sachs. It's important to know who's running your business, who's running the companies that you're invested in. You have to know that, you have to care. So when you see Anthony Noto, the guy from the COO of Twitter, the former CFO of Twitter, CFO of NFL, he was at Goldman Sachs. He did the deal with the NFL to get SoFi's name on the Los Angeles Rams' stadium, which will be hosting the 2024 Olympics. He did all of that. You want to know why he did it? Because he has that background. He knows what he's doing. It's very important. So don't just look at this slide and say, oh, they're trying to just be fancy and sell retail investors who are dumb and just want to see pretty things. It's important to know who you're invested in. Let's keep going.
It's the team. They come from, Goldman's, Amazon, TPG, all this sort of stuff. Very nice. Okay. There are app pictures, which are also pretty, but again, none of that matters. Now, member growth, year-on-year member growth, 75%. That's great. That's absolutely fantastic. And it's the last year-on-year growth from Q3 2019 to 2020 was 74% growth. And they're expecting that to continue. So 75% member growth rate, that's brilliant, right? That's just like, wow, real growth story here. That's exactly what we want to see.
Felix is right there. He's completely right. Membership growth at 75% per year or year over year. That's very good. Why is that important though? Because of vertical integration of centralized services. They're focused on members so much because the membership decreases the cost of revenue over time. The more members they have, the less people they have to market to, they have to spend money on to market to, which is why 65% of their home mortgage sales last year came from their customers, their existing customers. That was free money for them. So that's the importance of this fast growth. So Felix is completely right on that. So let's keep watching.
One of these companies. Now, what does it mean though? Now, the rest of this deck is basically about cross-selling. And it basically tells you if we get them in on the brokerage, we're going to sell them a loan, we're going to sell them a home loan and a car loan and insurance. We're going to sell them all these things. And the acquisition cost, therefore, for those additional products is lower and lower and lower because we already know them. It doesn't really cost us any advertising money. It's very easy for us to do. Now, that's great. But that's not new. That's what JP Morgan does since the beginning.
It doesn't have to be new. It's called running a business. Why does that have to be new? It's marketing. Most businesses are not new, they're just doing better. So JP Morgan is not a good comparison for SoFi because SoFi is actually crushing them when it comes to growth. And we'll talk about it later.
Time and any majorly successful bank does exactly that. So that's nice, but that's not really your USP.
But they actually don't do that. They might offer some of these things, but people don't use them as such. People aren't falling in love with those existing banks, those legacy banks. People love SoFi because they focus on the millennials, on the high earners. They know how to serve them right. Customer service is very important. So yeah, everyone can offer these things. But how do you do it? Do you do it in a way that satisfies your customers? That's what's special here. So let's keep listening.
Your USP is that you're doing it online. You're doing it without all the staff, without all the back office, without all the overhead. So what we would expect to see is a huge profitability improvement over, say, a JP Morgan or a traditional bank, right? That's kind of what we're looking for here. So let's look for the numbers then, and they are usually hidden.
Eventually, keep that in mind. The key word, the key mindset here to what he just said is eventually you want that stuff. You want the higher profitability, but you don't need that right now. So keep that in mind. Let's listen to what he says next.
Here somewhere. Are they in here in this deck? No, they're not in this deck. Oh yeah, here they are. Here they are.
Okay, watch what happens here. This is the funny part. Let's watch what he does here.
So is there a pretty chart with it? I'm sure there is. No pretty chart, but okay.
Do you see that? He spent like 2 minutes earlier complaining about the fluff and how pretty it is because they want to target dumb retail investors who don't want to look at numbers and don't want to look at charts. They just want to see pretty stuff and pretty girls. And now he's presented a spreadsheet of numbers of the facts of the deal. And he's asking for a pretty representation of that. So he spent all that time complaining about how dumb retail investors are and how they're getting fooled by IPOE and targeted. And now they show him what he wants. And he says, where's the pretty stuff? Give me the pretty stuff. So Felix, come on, Felix. Come on my show. Let's talk about it. I'm not trying to poke fun at you, but I just find that to be very curious that you just did that. And you didn't even notice it.
Now, what we've got here, sure, there was a pretty chart somewhere, but anyway, we can look at the spreadsheets, right? We can read spreadsheets. Let me just make this a little bit wider for you guys. Apologies, it was a little small before. So what we've got here is EBITDA, which is not the greatest measure of profitability because it excludes depreciation. That's more of an issue for...
It's what everyone's doing. It's what tech companies do. It's standard at this point. So yes, he's right. It's non-GAAP. It's not the traditional measure of profitability, but that's what most companies in this space in tech do, right? So SoFi is a fintech company. They're going to do EBITDA too. That's what the industry is moving towards too. So yeah, fair point, but doesn't really matter that much.
Sort of factory manufacturing type companies, this isn't that, so we're going to look beyond that. So they're saying for this year, they're going to have a 3% EBITDA margin. Okay. And for next year, 17%, for the year after 23, 28%, 32% in 2025. That's what they are forecasting here. Now,
okay, guys, it's going to get very good right after this. And it's going to be very important what happens next, because this is why I got a little bit upset when I was watching this the first time around. And I was talking to my Discord members, because he goes through these numbers and he's going to see an error very soon that he makes himself, but he just keeps going with it because I don't know why, but he keeps going with it and puts out misleading information. But before we get to that, if you're enjoying the video, don't forget to like the video below. It helps me know that you all enjoy this, so I can keep doing videos like this, and it helps YouTube spread my video to other investors who want to know how to invest and how to analyze deals, and of course how to spot misinformation. So if you enjoy it, please do hit that like button, subscribe, hit a comment in live stream. Let's get to this real quick. Nate Jones says, I left a comment on his video earlier that he was missing out. That's right, he is missing out on SoFi. And Noah says, can he trade IPOE options after the vote on Friday? That's yes, you can. Once they go public as SoFi on the stock market, once the merger is done, you'll be able to trade options as you would with any other stock from your broker. So it's up to your broker. And thanks, Yanni, for responding to Noah. And Roger says, by chance, do you know the retention for SoFi members? Was it 65%? No, it wasn't 65%, but I forget exactly what it was. We'll get into that. I'll definitely, Roger's a patron, so I'll respond to him on that in the Discord channel. So thanks for engaging. Let's get to it. Let's keep watching.
That's surprisingly low. And I'm going to show you why that is surprisingly low, because look at JP Morgan's EBITDA margin. Over time, it's always been around the sort of, not always, but as far as this chart goes back to 2010, around the 40% mark. And at present, it's 60%. 60% EBITDA margin. So
that's right.
These guys here, the new kids on the block with their super efficient online only, we don't have branches, 32% in the end of 2025. So in 4.5 years, your margin is half of that of JP Morgan. What are you doing with the money? Where are you spending it? Is your technology that expensive? Your service?
Okay, guys, I'm sorry. Need a little second. Okay, so again, he's comparing apples and oranges. JP Morgan is decades old. I don't know, maybe even a century old. I don't know how old JP Morgan is, but SoFi, they're young. Look at this. Their EBITDA margins in 2019 was negative 33%. This is my point. Just listen, just give me a second. I need to make the point. 2019, they had negative 33% EBITDA margins. In 2020, they had negative 11%. And now in 2021, they're on track to have 3% EBITDA margin. In 2 years, they went from negative 33% EBITDA margins all the way up to 3%. Positive 3% EBITDA margins. What does that tell you? That they spent years investing in their growth, investing in their future revenues, in their future profitability, by acquiring members aggressively, by buying the naming rights to the NFL stadium, by doing all these deals, by offering all these services, these financial services that keep their customers in their ecosystem, that attracts more customers. And when their customers sign up, they become very loyal to them. Like myself, I started using SoFi back in 2019 because I had a student loan for refinance, and now I use all their other stuff. I even just got a personal loan through them, right? Instead of going with Rocket Mortgage or with JP Morgan or with Wells Fargo's, I used SoFi because it was so easy for me to just open an app that I always use every single day to just say, hey, I want a personal loan now, SoFi. And they did it in a day. I had the money the next day. That's the beauty of SoFi. So they spent all those years investing in that. That's why they had negative 33% EBITDA margins. That's why they were losing so much money. And then a year later, they cut that down to 11%, negative 11%. And then 2021, they expect to be EBITDA margin positive at 3%. And what does that tell you? That they can quickly increase their margins if they want to. If they want to increase their margins, they can do it. So in 2022, they expect to do 17% positive. Excuse me, I'm a little sick from allergies, but I'm trying my best. In 2023, they expect to get to 23%. And in 2025, they expect 33%. Of course, that's a far way out. We can't really trust that too much because it's so far away. But based on what they've done in the past, I trust them to actually meet these marks because they've shown me that they can go from negative 33% in 2 years to 3% positive. So, but JP Morgan, based on what he just showed us, is stuck at 44% to around 60% in their very good years, in the year when there's catastrophes and people are losing all their money. But the point is that JP Morgan is a old company who's getting by. They're just going just floating on by. But SoFi is going like this. And they can go like that if they want to because they're so young and they're doing it better. So he's comparing a super old company's existing margins that have been going on flat to a company that has just grown from negative 33% EBITDA margins in 2019 to 3% expected in 2021. Even if you don't trust them to hit that 3%, they already did negative 11% last year. So they can cut their cost at any time if they want to, and that's what they've shown here. So if you take his word and say 32% in 2025 is not going to be good enough for SoFi, well, okay, fair. You're right, Felix. 32% is less than 44%. I can't argue with you there. That's just math. But what happens after that? What happens when SoFi gets their bank charter? What happens when SoFi becomes a bank and they decrease the cost of selling loans, personal loans, student loans, car loans, right? Home mortgages? They pay other banks today to sell those products because they're not an actual bank themselves. But in the future, they just bought a bank this year. They're buying a bank. So in the future, they will cut the cost of those loans and they will far surpass this 32%. So ask yourself, how long is your investment horizon? What are you looking for? Are you looking to invest for 2025? Or are you looking for 2030 or 2040? Right? What happens next? What happens after that? So yeah, if you're just looking for 2025, then yeah, go invest in JP Morgan and Chase. Okay. But I'm looking for what happens next. What happens with the bank charter once we get it? What happens with Galileo, which he hasn't even talked about at all in this video? Galileo is the Amazon of fintech, Amazon Web Services of fintech. Amazon Web Services brings in billions and billions and hundreds of billions of dollars every year because they're the infrastructure by which other companies run on. One of his viewers commented on his video saying that Revolut is bigger than SoFi. But guess what I commented? Revolut is a customer of Galileo. And guess who owns Galileo? SoFi. Revolut is a customer of SoFi. So when Revolut wins, SoFi wins. When Robinhood wins, SoFi wins. When Chime wins, when Dave wins, when Moneyline wins, SoFi wins because they own Galileo. They own the infrastructure. That's the beauty of Galileo. 20% of your revenues, 25% is what they're projected for 2025. I think they're going to do even 30% in the future with Galileo. And he's missing that point. So what comes next, right? This is a growth company. JP Morgan Chase is not a growth company. They're barely doing 10% per year in revenue growth. 10%. SoFi is doing at least 25. They expect to do 44% in 2025. So comparing JP Morgan Chase to SoFi, come on, Felix. Come on, man. Let's keep watching.
Your staff, your sales cost, your acquisition costs are so high. Strange, wouldn't you say? Now, if I simply gave you the option,
I wouldn't say
everything else was equal, of investing in a company with a 60% EBITDA margin, which is essentially...
But everything isn't equal. You can't just say, if everything else, given everything else is equal, and their margins, JP Morgan's margins are better than SoFi's, I'm picking JP Morgan. Well, yeah, if everything's equal, and this one metric is better in this company B versus company A, I want to pick company B. Who wouldn't do that? Who would not make that choice? So you can't just say, if the sky was green, the sky will be green. Okay. Well, the sky's not green. SoFi is growing at almost 3x the rate of JP Morgan. They're tripling their revenues when JP Morgan can barely do 10% per year. So you can't just pick and choose your stats and say JP Morgan is a better growth company, and then have your viewers believe that on wrong numbers. And he's gonna go on and use his wrong number from earlier in the video of 16% revenue growth, comparing 2020 revenues to the last 12 months, which include 2020. He compared the same year to itself pretty much, and then used that as his basis for saying that SoFi was a poor growth company. The argument is completely flawed. So all of this, all these numbers, he says, look at the numbers. But if you look at the numbers, you have to look at the numbers and understand them. You can't just look at them and then make up your own numbers, your own math. There's math. You have to do the math. They even do it for you and they show it to you and you just disregard them. Let's keep watching. I'm ranting, but it's important that you understand that you can't just say stuff and then have it be so. These are companies we're dealing with. There's numbers here. Unless there's fraud being committed, which is rare in public companies, then this is completely wrong. Let's keep watching. Let's see if all is the same. Let's see if oranges and apples are the same.
A profit margin before tax, depreciation, and amortization. And if you want to understand what those terms are, guys, again, I'd encourage you, check out my course, because I explain what those terms mean, because it's confusing to most people, right? And not just to you, it's confusing to absolutely everybody, these acronyms. And it's important to be able to understand income statements. So again, I'd recommend you check that out, guys. So why are they... What is taking them 4 years to reach half of what JP Morgan's doing? Who are, the old bank, the dinosaur, the gray.
They are a growth company. They're a growth company. They're growing. That's the whole point of growth companies. They're not trying to make all the money they can today. They could do 50% or 75% if they wanted to tomorrow in margins. They could just stop growing. That's how you increase your margins, your growth margins, or your EBITDA margins, your profit margins. You want to have higher profit margins? Do you want to have 100% profit margins? Here's how. Stop spending money. Stop growing. That's how you get your margins up to JP Morgan 60%. If you see margins that high in a company that's not growing, you have to ask why. And the answer is right there. They're not growing. They're staying flat. They're just staying. So why are they taking so long? Because they're growing. You just saw them grow their membership by 75%. They expect to have 4 billion members this year. That doesn't come free. That comes with expenses. And margin is calculated by your income minus your expenses. So if you're growing at 75% in your members, that comes with a cost to do that. So let's keep going.
People gonna go away, that sort of thing. This is a little bit unusual. So I don't really understand this. Now, the profit forecast and the revenue growth. So the revenue growth is basically 16%.
You hear that? Did you hear that? Did you just hear what he said? He said that SoFi's revenue growth is 16%. When I listened to this, I wanted to give him benefit of the doubt. So I listened to him like 10 times saying that to see if he meant to say 60%. But he says 16 over and over again. Do you want to know where he got that from? From his prior error at minute 4 in this video when he compared 2020's revenues to LTM revenues last 12 months ending in March of 2021. So the last 12 months ending in March of 2021 includes the first 9 months of 2020. So that's where he gets the 60% from. And it's actually 20 some percent. That comparison is 20%, but that's still wrong. They give you a number right here. The number is right there. 43% is their compounded annual growth rate over time. Right? So that's about how much they expect to grow over the next 5 years. But 2020 to 2021 is actually 50 some percent. So he got it completely wrong. Completely, utterly wrong. You want to know why? Watch. Let me just show you something. Just watch what happens next.
That's what we're being projected here. Net revenue. So we are basically getting here from 2021, 22 to that's generously 16% up and so on, and it continues at a.
Do you see that? He says 16. I thought he would say 61, but he says 16 again. That's not correct. That's more than 50%. So, and you want to know what? You want to know how fast JP Morgan's growing? Their revenues anywhere between 9% and 13% per year. I don't see what his point is here.
At about that rate. So 16% revenue growth. Now, there is another financial institution I can think of.
And again, I remember I said I wanted to give him the benefit of the doubt. I thought he said 60, but he said 16. And next, he's going to prove that he said 16, which is completely wrong. I don't know where he's getting that number from. And you saw him when he was looking at this 980 versus 1500. He couldn't figure out. He couldn't reconcile 16% to what he was seeing, which was 50 some percent on the screen between 980 to 1500. So he was still stuck on his previous error from earlier in the video. And no matter what his eyes were showing him, 980 to 1500, 50% growth, he was still stuck on that previous error that he made. So if you make an error, fine, we all make errors, but don't just keep going with it. He was stuck on that. So now we're going to see him double down again on that. So let's listen to what he says about PayPal.
And that's PayPal. Now, PayPal has the last 12 months a revenue growth of 25% here. Make this a little bit bigger for you guys. And you see that 25% last 12 month revenue growth. And the previous years were sort of around 20%, and then it goes down a little bit. But okay, they are growing at a faster rate. PayPal, we've been around for absolutely forever. I mean, they came out of eBay, right?
2000s.
Been around for more than 20 years, because I remember having an eBay business back in the days. I don't understand why their growth, the revenue growth, is slower than than PayPal rather, and their profitability in 4.5 years' time is less than JP Morgan's right now. So,
first question, Felix, here's the answers for you. First question on PayPal, why SoFi's revenue growth is lower than PayPal's 25% in 2020, 2020? They had 20% revenue growth. It's not. IPOE or SoFi is growing at 25 to 44%. So even at 25%, if you say that PayPal's on 20%, SoFi's doing at least 25%. So they're not less. That's their lowest in a bad year. So first answer is it's not. That's wrong. That's a bad comparison. Second question, because JP Morgan Chase, because they're still growing. They're still spending money to acquire customers, to acquire members. That's when you do that, it costs money. So that's the answer. We're almost done here. There's not too much more. I know it only says 13 minutes or 14 minutes in of 27, but it's almost over. I promise. Let's keep watching.
Yet it's a growth stock. That's going to be much, much more speculative because I don't know if they're going to succeed, really, do I? Whereas JP Morgan and PayPal are much less likely to go away. So now the growth is a good story. I mean, it's fine growth, right? And the story is good. That's really what I mean by that. I mean, the story is good. The disruptor, the Henrys are your customers, high income people who are going to become more profitable. Are they going to be loyal? Well, I think probably not, because the fact that they've moved to you means that they've moved their current account from another bank, or they maybe still have it, and they're jumping around. They're shopping around for the better rates, right? So
if you're looking to JP Morgan and Chase for a better interest rate versus a online bank, you're losing that battle, Felix. SoFi does, before the pandemic, they were doing like 2.5%, 2.25%. I was living off of their interest rates in 2019 when I quit my job. So to go raise money for my startup. So that's a bad comparison too. And people are shopping around. Yeah, we know that because SoFi has said that people have multiple banks just because they need various services to serve their financial needs. And why does SoFi exist? To bring them all under one house. And that's why they're growing so fast. So let's keep watching.
The whole brokerage stuff that they're offering, they're saying, we are going to be the greatest brokerage out there. We're going to give you access to IPOs. We're going to democratize this whole investment process. Well, Robinhood's saying the same thing. Weeble's doing the same thing. There are dozens of apps that basically do that, all with near zero fees. So
that's CNC, right? That's yes and no. SoFi is doing things that Robinhood is also doing, but SoFi can do things that Robinhood can't do because they're pursuing a bank charter. So what he's saying here is that Robinhood is going to offer IPO investing for retail investors, which is new. We haven't been able to invest in IPOs at the IPO price before this, but SoFi did that first, and they're going to continue to do it, right? So yeah, he's saying that Robinhood does it too. So what's cool about you? What's different about you? What's different is that once SoFi becomes a bank, they don't have to go through other banks to do their business. So yeah, Robinhood can offer cash management, but it costs them money because they have to partner with another bank. So yeah, there's so many answers to all these questions if you just look for them.
How do you differentiate yourself on that? I think most people who have one account probably also have another one, at least to check it out. It was free. Maybe they got $100 or a couple of stocks free or some sort of incentive. So I think this is a space that's fairly fluid. Now, there might...
He's completely right there, actually. What he's saying is that people have multiple brokerages, and that's right. I have multiple. I love Robinhood because they're so delightful to use, right? That's where I have my growth stock. That's where I have all my hundreds of thousands of dollars in there. But then I have M1 Finance for my emergency fund portfolio. So I have another brokerage, right, for my passive portfolio. Then I have SoFi for my future tech passive portfolio because I like SoFi more for that. And they're my bank account, right? That's where I do my banking. That's where I do my loans, my personal loans. So I use their investing app too, right? And they have products that neither Robinhood or Webull have. SoFi just came out with their weekly dividend ETF. That's completely new. No one has done that before, right? At least I don't know. If you guys know of anybody who's done that before, let me know in the comments below. I'm not sure. I haven't heard of anybody else doing that. I think that's brand new. But Robin doesn't have that. Webull doesn't have that. Charles Schwab doesn't have that. SoFi has it. And it's all under one roof. That's the value. He's not getting that. Vertical integration of centralized services. Vertical integration of centralized services. The vertical integration makes the cost of doing business cheaper for SoFi, and centralization makes the customer happy because they have all what they need to succeed under one roof. That's the value here. That's the thing that he's missing. That's what makes SoFi special and what makes SoFi my biggest investment, right? That's why I'm so bullish on this company. Vertical integration gives me goosebumps, because it cannot be understated how valuable that can be if you do it right. But then you add centralization into it.
Be at the end of the road, the sort of winner takes all approach. But I think it's unlikely. I think just like in banking, we're not going to have just one brokerage out there. So it's a highly competitive space on the brokerage side, especially because of Webull and Robinhood and all the other apps out there who are very aggressive in their way they promote. So let's...
And just be clear, he's right about that. Robinhood is very good. I'm going to invest in Robinhood once they go public. Webull, I've tried Webull. I didn't like it. I couldn't even get past the sign up because it was just so, I'm not sure why it was so hard to get through that. But SoFi doesn't have to beat Robinhood or Webull. They don't even have to compete that much with them. All they have to do is be at least as good as them or close, right? And offer similar services and some exclusive ones like their weekly dividend ETF that no one else offers. Why is that important that they do that? Because they want to be a one-stop shop. They want to say, hey, we have everything you need and we do it well enough, right? And some stuff we do even better than anyone else, because we want to keep you in our ecosystem and help you achieve all your goals in one place. And when you need to get a house, to buy a house or go back to school, we will have all the loans you need right here. And we'll give you the best rates. We'll match anybody else's rates, because that's how you grow with free marketing, right? The revenues become cheaper to acquire in the future because they continue to grow their memberships and continue to keep their members for a longer period of time. They increase their lifetime value of their customers, and they decrease their customer acquisition costs because of vertical integration of centralized services. It's very important that you understand that. Remember, I told you at the start of the video, it's going to be the same thing over and over again. That's the theme here. Vertical integration of centralized services. That's how SoFi wins, right? And then you add in Galileo. You add in the bank charter, right? So much more that he doesn't even touch in this video. But let's see. I think this is where I stop watching, because he goes into talking about when you should buy charts and all that stuff. I don't do charts because I'm a long-term investor, right? You don't really have to care too much about the short-term charts, but that's the whole video. But we can finish watching this so that I give him his fair time to let you all know what he thinks, and I'll see if there's any more critical parts in this video that I can comment on. But that's what it is. Let's keep watching.
Look at the chart.
Oh, before we do, let me just get quick to the comments in the live chat. Elliot says, enjoying this breakdown. Thanks, Lincoln. Of course, Elliot, thank you for being a patron. And that's the last live comment. I hope you guys are enjoying it. If you are, don't forget to hit the like button and comment your thoughts. Live chat. I wanna see what you guys all think, and let me know if I made any mistakes too. Let me know where I messed up, or let me know what I'm not seeing, because I've seen all of the arguments for and against SoFi, and so far I'm not too concerned with the negatives. I have my own thoughts on what the negatives are that nobody else is talking about, and I was gonna make a video on that this week, so I will make that. Just stay tuned for that, and let's just finish what he has to say here.
And the first thing is, of course, you have to realize this is a SPAC. And let me turn the percentage. SPACs list at $10. They typically are funded with $2 billion US. And then they say, well, we might acquire something in some sort of sector or the other or not. And there it is. And then people invest on the basis of that. And then there are rumors that there is this deal that's going to happen with SoFi. And, then it jumps up absolutely tremendously. So in this case, the stock went up about 83% on the 7th of January. Well, 57% by the end of the day, but it actually did jump up quite a lot higher. And that's all very nice. But then it went higher and higher and higher and higher to sort of insane levels. And then it's coming back down. And now it sort of sits here around, what's the percentage? What's around the sort of $16, $17, $18 mark, and sort of where it's bobbing along. And it is building some support here, but not the greatest support. There is still a little bit of that negative trajectory here. So on the basis of the chart, would you buy it? Well, it's a negative trend over time.
Doesn't matter what the chart
definitely are
says.
not as exuberant about the acquisition as they were when it was first announced. And also remember, beginning of January was a space where everybody was very, very psyched up about SPACs. And that's exactly, if you've been following me since that time, when I've been telling people, think about buying value stock, think about buying stocks with high free cash flow, high profitability, because the inflation fears are going to hit the growth stocks over the head for this particular period. So put fresh money into those. Don't run and hide. But that's what I've been saying for 5 months or so. And again, guys.
And that's fair. If you are afraid of inflation and you're trying to make money through dividends by investing in high profit companies, then yeah, invest in those companies. But if you're looking for growth, that's completely antithetical to what your goals are. Your goal for growth company is to invest in a company that's young, is still growing, which means that their expenses are higher than a non-growth company, because you believe that in the future they're going to be able to off or stop spending so much and actually make a profit, right? By decreasing their expenses because they've grown enough where they can start focusing on making money, on actually making profits. But as for the future, if you want that now, you're not looking for growth. You're looking for a safe investment that is actually making money, and you might want dividends for it. And because you're a dividend investor and you want to make passive income, or you're just retired, and that's what you're ready for. You're ready to maintain your wealth. But if you're in the stage of growth, of building wealth, you're not looking for just profitable companies. That's not what's most important to you. What's most important to you is whether or not these companies are growing today and if they can become profitable in the future. That's what's important, right? There's two stages to wealth. There is wealth building and wealth maintenance, right? You have to build it and then maintain it. So you have to figure out what stage you're in. Don't just listen to some YouTuber who's telling you, oh, go buy the most profitable companies today because they're more profitable than the growth companies. If you want growth, that's not what you believe in. Right? That's not what you're looking for. You're not looking for the most profitable companies today. You're looking for who can become the most profitable in the future. But today they're still growing. They're still spending money. They're not profitable that much. And if they are profitable, it's 3% or it's 20% or whatever, right? Because you believe that they will continue to grow. And in the future, it might be 40%, right? Or 35% or whatever. But what he's saying here is only half good. He's making a good point about inflation that's coming out if inflation does increase. But what you do with that information, what he's suggesting, is not really meant for growth investors, people who want to invest in appreciation, right? So let's finish. Let's keep watching. I know I keep saying let's finish, but let's keep watching. I want to give him his fair time.
If you want to understand inflation investing and really how to build a long-term strategy to really make money no matter what the market is doing and really understand all these economic indicators that are being bounced around, check out my course, guys. It's 39% off with the coupon FREEDOM, and that's what we all want, financial freedom. So
okay guys, so I have to say this one thing. I know I keep stopping, I'm sorry. Before I get to it, let me just get to Daryl Williams' comment. Daryl says SoFi isn't on the market yet. Yes, that's right. IPOE is on the market. And he says, why would the trend line matter at this point? Felix is off base. So I don't know too much about charts. I'll admit that. I'm not a short-term trader. I'm not a trader at all, right? I invest for the long term. That's what we practice here that's what we preach here on the channel, right? The bull mentality. The bull mentality is that we know what we invest in. We understand what we invest in. We believe in what we invest in, and we hold for the long term because that's how we build wealth in this country, right? That's how we give ourselves the best chances at success in the stock market, by investing in companies young and holding on for the long term and benefiting from the appreciation, the value of our assets. We are net holders of assets, right? That's been shown to work out very well for some people like Warren Buffett, if you know who he is, right? So I don't do too much trending. I don't do it at all. I don't understand it. I don't pretend to understand it. But Daryl seems to understand it, and he says, hey, maybe you should wait until SoFi actually goes public and starts trading under SoFi, SOFI, right? So that's what Daryl thinks. I don't know too much, but if you know trading and you want to follow Daryl, go ahead, comment in the live chat. But what I wanted to say was that I don't want to pretend to know what Felix's motivations are and what his incentives are for making this video. But one thing I want you to be careful of is people out there trying to sell you courses, right? And the reason I say that is if people are trying to sell courses, what they have to do, the way they sell more courses, is by pumping out more content and then upselling you on those courses, right? I do similarly. I make videos and I have a Patreon community to help more people, or a select amount of people, answer their questions, make a community for us to all collaborate on investment ideas. And they've actually helped me find my best investments, including IPOE, including SBE, NCCIV, Lucid Motors. So I've been helped a lot by my Patreon community, but I don't sell courses because I make YouTube videos for that. The information that I share are on YouTube, right? I just have my Patreon community so that I can help or select people who really need my help or want my help, and have one a community so that we can all collaborate. That's what I do. But people selling courses, they are selling it for hundreds of dollars, maybe thousands of dollars, and they have to make content to upsell you on that. And that means that they're going to make content as much as possible. And that means that they might not do the best research. They might not take the time to look into what they're going to talk about before they actually put that video out. So what I pointed out at minute 4 in this video was that Felix made a critical, fatal mistake in his math. And he used that as his basis of his argument throughout the entire video. And when he was faced with new numbers, the numbers right in front of him, they were given to him, and the math was clear that SoFi is growing by about 50% per year, 35 to 45, 50% per year in the revenues. He stuck to the previous lie, the previous, I don't know if it's a lie, but the previous misinformation that he came up with early on his video. Why did he do that? I don't know, but I can theorize that maybe it's because he had to just get this video out. He had to just get it out because he had to upsell his audience on his course. Again, I don't know. I don't want to pretend to know what Felix's motivations are, but that's just how I see it from this, right? So be careful who you're listening to. Know their incentives, know their motivations, why they're doing what they're doing, and why they're publishing misinformation. Because he saw this video, he edited this video. This wasn't a live stream. He edited this. He took his time, went through and edited it. He saw his mistake twice and still published it. And he could have very easily debunked all of his arguments that I've debunked by himself if he had actually taken the time to look at the graphs, to look at the presentation, and not just be a skeptic, because people love seeing skepticism. People click on that. People love to see train wrecks, right? So they click on that. It's easier to get views by doing that, right? So that's how I see this. I don't want you to think that I'm trying to bash Felix. The only reason I came out in this video so quickly, I wasn't planning to do this. One of my patrons, a B, messaged me in our Discord community and said, "Hey Lincoln, what's your thoughts on this bearish review of SoFi?" And so I was still at work, so I took some time off real quick and I watched the video. And I said, "Hey, here's my thoughts." But then I saw some of his viewers' comments that said, "I just sold all my positions. I just sold all my SoFi stock, my IPOE stocks, because of what you just said." Of course, Felix was very responsible and said, "Hey, this is just entertainment. It's not investment. It's not investment advice. Do your own research." He said that, so that's fair. He did that, but he put the information out there, and he has 20,000 subscribers, so he has a responsibility to put out the right information, not misinformation. And because he edited this and still published it with all the errors in it, that doesn't sit well with me. And I had to come out and at least warn my audience, right, that hey, I love SoFi, but I want to see counter arguments. But this is not one of them. This is not a good kind of argument. There is not one meaningful and correct argument in this video. And I've watched this twice now, by myself and then once with you guys here right now. So he might be short on it. Toys and Fun for Kids says Felix is short on it. So maybe, I don't know. I don't know Felix. I don't know anything about him. I don't want to bash him. But the only reason I'm doing this is just to warn my audience and other people who might be watching this video so that they can at least see a counter to what he said. And I think that he just did not research this. He didn't even take the time to do the math. Because if he had done the math, he would have seen that 50% is not 16%, right? And that PayPal is not a good comparison. It's not a good comparison to SoFi, and that JP Morgan and Chase might have higher EBITDA margins, but why? Because they have much lower revenue growth at 9%, 13%, right? Then SoFi, who's at 26%, 35%, 44, 45%. That's more than 50% at the lowest number and the highest for JP Morgan. So that's why they have lower EBITDA margins, right? It's a give and take. You want higher margins, you got to decrease your expenses, which means that you can't invest in your future growth as aggressively. So why? Ask the question, why? Right? You don't just say stuff. You can't just say, oh, if all else was equal. Well, no, it's not all equal. There's differences. The sky is not green. The sky is very much blue. And down here it's very much hot, and I'm sweating under this suit, right? And I have terrible allergies because there's pollen out there. I can't just say if there's no pollen, I will be great right now, because there's pollen right now and I'm sweating and I'm sneezing all day. So you have to ask why. You can't just make things up. And when you see the facts, you don't just ignore them. Like he did. He saw it. I saw it. I can hear it in his voice when he was looking at it. He took a pause and he saw 980 versus 1500, and he still says 16% when that's very much exceeding 50% growth. So that's why I make this video, and I did it live, because I want you to understand that we all make mistakes, and I've made mistakes in the past after publishing, but I will never publish misinformation knowingly. And I think that Felix published this knowingly just because he had to sell his course. So that's how I feel about this. So let's finish. I keep saying let's finish, but I'm trying my best. I'm sorry that we're running this. What is this? How long have we been on this? It's been a long time. I can't see the actual number, but we've been at this for a while. If you're liking the video, make sure you like the video. Like the video below. Comment, live chat in the comments below. Let YouTube know that you enjoyed this. Let me know that you enjoyed it so I can keep doing these videos, so that I can at least ward off some misinformation. And if you want to support the channel financially, join us over at patreon.boacademy.org. We discuss the stock market every day in real time. We discuss news, rumors, and share ideas so that we can all find new deals, do our own research, come back together, collaborate, and make better investment decisions together. There's no hype. I always like to see and share both ways, right? I don't want to just sell you something because I actually don't care. SoFi was down to $14 in March and April. I bought half my shares of IPOE in that time because it was so cheap. So I want my stocks to stay cheap for a while. I get paid every 2 weeks, right? So I get to buy more shares every 2 weeks. The cheaper it is, the more I can acquire. So I don't care if the stock goes up. I would love if it stayed down for the next 2 years so I can just buy it up, because I believe in the future of the company. So I'm not here to give you hype. I don't care what you do. I just want to give you the best information, give you both ways, and without all the fluff, which is just reason, right? That's what I do every day as a software engineer. I just think and apply reason, logic, and think about all sides, all edge cases, all the problems that can occur, and then build the best experiences for my users, my customers. So that's who I am. But there are different people out there. We're all different. So be careful who you're listening to. And if you enjoy someone's videos, hit like. Let's keep watching.
What I would do is, okay, I mentioned two other stocks in this, right? PayPal, I mentioned down here, and I mentioned JP Morgan. The blue line is JP Morgan, the orange line is PayPal. At this level, it kind of looks like, well, IPOE is soon to be SoFi has massively outperformed those two. But that's really because of this spike here at the beginning. If you ignore that spike, so we jump past that day, it actually looks a little bit different. So JP Morgan since the 12th of January has done 16% up, PayPal up 5.5%, whereas IPOE has gone up 1.8%. And it makes sense. And why does it make sense? Because here you have a business that is, yes, very nice. It's a good business. It is sort of the future of banking. I don't disagree with that. I think our banking will move, a lot of it will move out of the old world. It'll move into essentially apps, because PayPal did that, right? Everybody's like, well, at the beginning, 20 years ago, maybe you were too young. I still remember, hence the gray hair. People were like, well, is it a bank? Is my money safe? And all these things. I actually feel my money is safer in PayPal than it is in most banks. And that is continuing, that whole space. And you see businesses doing, because it's just easier, it's faster, lower fees, it's instant, it doesn't take days and days. And, blockchain, all these things are going to feed into this trend away from it. But the old banks, the good ones, and JP Morgan, third largest financial institution in the world's largest bank, if you discount MasterCard and Visa card, they are not going anywhere. They are in on the blockchain business. They are using it for trading. They've got unlimited funds. I wouldn't bet against them. Yes, there are old, medium-tier graying banks that I would bet against, but probably not JP Morgan. Now, I'm not recommending that you...
And he's right. JP Morgan is a great business. I'm not trying to bash JP Morgan either. But they're very different in their life stage than SoFi. JP Morgan might be still trying to grow a little bit, but they're mainly staying still. They're staying at their 43% margins and their 9%, 13% revenue growth, right? They're staying down low. SoFi is still in their growth stage very early on, right? So they're still going to be growing very fast in the future. So this year they're only doing 3% EBITDA margins. In the future, we expect it to go up to 25%, 30%, right? Maybe one day 40%. So, but that's in the future. We're investing for the future today. So we take advantage of the stock being down right now. And then we buy it. We buy it up. And in the future, once they reach their goal, once they become their future self valuable, we benefit from that appreciation, because the stock price will reflect that growth over time, right? You might think the stock price isn't correlated to their actual underlying business today, but it all works out over time. So when SoFi makes $1 billion a year or $3 billion in 2025 or 2026, and you give them a price to sales multiple of 15, 21x, they go from being a $16 billion company to being a $100-some billion company in the future. So you benefit from that appreciation, from that 15, 16 billion to $100-some billion. That's going to be the spread between where you bought it today and where you continue to hold in the future. And those people who become the wealthiest people in this country and around the world ever are those who buy and hold. Forget what the day traders say. Forget what the swing traders say. They call you bag holders. Say thank you. I appreciate it. When you come running back from my bag in the future, I won't sell it to you, because I'm going to continue to hold it, because I'm a long-term investor and I believe in the future of my companies, and I'm going to benefit from that. So let's keep watching what he has to say.
At JP Morgan at this particular point, I don't really make those kind of recommendations, but I want you to think about what is the right thing to do here. And for me, and this is a personal opinion, I am not going to buy this. And there are two reasons for it. The growth rate is lower than PayPal. The margin in 4.5 years projected, which comes with a huge amount of risk, and SPACs have very little regulation at this point with forward-looking statements. All you got to say, it's a forward-looking statement. It may or may not change, and you can print more or less anything. I'm not saying the SoFi guys are being dishonest here. I'm just saying that their projection is half of the margin I can get with JP Morgan.
He keeps talking about margin, EBITDA margin. It doesn't matter. It doesn't matter. They're different companies. JP Morgan has high margins because they're not growing. So he just said that PayPal had higher growth than SoFi. That's completely categorically wrong. There's no argument to make there. SoFi is growing at 25, 45% per year, 35% per year. PayPal's revenues in 2018 was $15 billion. Guess how fast that growth was? 18% over 2017. In 2019, PayPal had revenues of $17.7 billion. Guess how much that was? 15%. 15% is less than 18% from the year prior. They're decreasing in growth. And then in 2020, they had $21 billion of revenues, which is 20.7% increase over 2019. 20% is less than 25%, right? It's less than 35%. So how can you tell me, or your audience, Felix, that PayPal is growing faster than SoFi, a much younger company that's investing much more aggressively in their future revenues? How can you say that? Here's the answer. And again, I said before, I don't want to presume to know what Felix's motivations are. But what I can see is that he doesn't care what the information is. He doesn't care what the truth is. He's just saying whatever he wants to say. There's numbers. We have stats. We can actually just go on Google right now. Let's do it right here. Let's go to Google. PayPal revenue growth. That's what we gotta do. Just Google that, and we can see it. I just read it to you. It's all right here. There's numbers. We don't have to just make things up. There's numbers for everything. All you have to do is respect the numbers, Felix. You said it yourself. You said, let's look at the numbers. Don't give me fluff. Give me the numbers. You saw the numbers and you disregarded them. Like they were just toys. You could just say, I don't want to play with this anymore. You can't just disregard the numbers, Felix, especially when you're talking to 20,000 people on your YouTube channel who believe you and then sell all their stocks because you said that JP Morgan and Chase is a better investment than SoFi because they have higher EBITDA margins. How is that a growth measure that you put over revenue growth? How is that what you predicate all your decisions on? It's not, because I don't think Felix is actually looking at numbers. I don't think he's taking the time to do the actual research and respect the numbers on the sheet. He looked at them and said, oh, that's different from what I previously said, but I don't care. I need to sell my courses. So I'm just going to publish this video. I've made videos in the past that I've had to just throw out because I made a mistake and it was too critical to even use the video. I've done that maybe once or twice. And I know it's hard. It's very hard to do that. You could actually just cut it out and add a little correction. That's what I do most of the time. I just say, hey, I made this mistake in the video. I gave you the wrong number. Here's the correction right here, right? People make mistakes. You could just say, hey, I made a mistake. Here's the actual number. If you do it multiple times, just say, hey, there's the actual number again. I'm sorry. But don't just keep going with your lie and keep pushing it. That's not how that's not responsible. That's not fair to your viewers, Felix. And you had someone who sold all their stocks in a what I believe to be a great investment because you told them that PayPal and JP Morgan and Chase are growing faster than SoFi when that's just not, none of the numbers bear that. The numbers don't say that's true. So let's look at Felix's comments. I think I want to finish this video, but before we go on this, because I'm ranting and I want to show you why I'm ranting and why I care about this so much, because this is not fair. And you can see here, this is not a great ratio for YouTube, right? I've seen this before. It doesn't feel good. So you know you made a mistake when about 30% of your engagement is a dislike. So people can tell, right? So why I'm so upset is that, let me see, one of his viewers here says they sold all of their shares. Where is it? I commented on it earlier. And most people are just saying I bought more IPOE today. But I want to see where he said I sold all my shares. Oh, there it is. This guy right here. He said I sold my positions after watching this video. I'm only looking for quality growth. Can you please do Tilray? And so Felix says, he does the responsible thing and say, hey, this is entertainment. And then Simon says, do your own diligence. So this is why I'm so upset. Because someone watched this video, some guy out there, the same people that he called dumb, that he says that IPOE is trying to make pretty presentations for because they're not smart enough to actually look at the real numbers. He's putting out videos out there to 20,000 subscribers. Look at this, 20,000 subscribers. And the numbers are wrong. He's using the wrong numbers and he's still pushing them. It's completely wrong. Just a simple Google search gives you all of what you need to know. That IPOE is growing faster in their revenues than PayPal. And you can do the same thing you can do the same Google search for Goldman Sachs. Let's do it. Goldman Sachs. Not Goldman Sachs, sorry. JP Morgan Chase. Revenue growth. And we can see what the revenue growth is. Sorry, wrong link. It's on microtrends. Look at this. 2018, 13%. 2019, 9%. 2020, 8.9%. Decrease in growth. They're decreasing in their growth rate. And you're telling me that they're faster growth than SoFi? They're a better growth investment in SoFi? How can you tell your audience that and just let it be? Well, because we got to sell the YouTube course, or the courses. So hey, go get your money, right? That's why I say here, go get your money. However you got to get it, go get it. But be a good person, right? And don't mislead your audience. The reason I don't have to sell courses is because I'm a software engineer. I make enough money, way more than I need, as in my day job. So I can afford to tell the truth and be very much objective. And even if I had to make money, I wouldn't mislead my audience like this. This is just blatantly wrong. Just simple Google searches gives you the right answers. Let's look at some comments real quick. Some live chat comments. Thank you all for engaging. If you're enjoying the video, don't forget to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts. Live chat and all of that. And if you want to support us financially, join us over at patreon.boacademy.org. You'll get engaged on our Discord channel where we share resources and news and rumors and all that stuff. I already said this many times, so let's get to some live chats. So Abin says easy and slow supporting Lincoln. Thank you, Abin. I appreciate it. He says that he's here for the long run. And Flavoring says SoFi needs to add Doge to the app to buy. Hey, okay, that's fair. I have some Doge, and that's my lottery ticket. I don't believe in cryptos. I don't believe in Doge, but I'll take free money. Why not? And Jay Hoy says buy. Simple. That's it. Just buy. And Malik says Felix types are the ones that told people to sell Amazon and Tesla. LMAO. And Malik also says, heard some poor guy sold his IPO after listening to you. You have the wrong data and you are screwing people with their money. That's how I feel, Malik. I agree. So that's why I came out so quick to make this video, because right after I got off work, I said I gotta get this video out. And I wouldn't usually do that because I have a lot of things to do. And that's usually reserved for our patrons at patron.boacademy.org. So if you want to subscribe there and support the channel financially, keep this channel going, you know where to go. So let's just finish this video, because like I keep saying, I want to give Felix his full time, 27 minutes. We're 21 minutes in. Let's keep going. Let's finish this video.
At this point. So why would I bet against one of the greatest sort of fintech kind of payment processing software companies, PayPal in the world? Why would I bet against the largest bank in the world on the basis of basically pretty pictures and that there could be the next Uber, there could be the next Facebook? Yeah, there could be.
They never said that. They never said that. Remember, the only reason they show those pictures is because they're making an investment presentation and they're saying, hey, look at these winner take most winners. And that's what we aspire to do. We aspire to win our market and take most, and then one day our logo will be in the realm of these winner take most companies in their sectors. We're not trying to be Uber, we're not trying to be Amazon, we're not trying to be Netflix or whoever, but we're gonna be a winner that takes most like them. So no, it's not the same thing.
It could go out of business. I mean, not saying they're going to go out of business. I think it's a good business, but the valuations are pretty steep. They are selling this to retailers like you and me. They are not going
wrong again
and selling this to the big funds, the big corporate buyers. Because
this is so SPACs. We've covered SPACs on this channel, special purpose acquisition companies. The way they work is it's simple. And anyone who knows what a SPAC is knows that what Felix is saying is completely and utterly wrong. In order to put a SPAC out there, you have to sell to institutional investors like any other IPO. SPACs go through an IPO first. And who buys the IPOs? The institutional investors. And who owns IPOE? 40% of them are institutional investors, right? Around 40%. 40%, around 38 or 48% own IPOE or institutional investors. So this is wrong. And you know what deck they showed those institutional investors? A much similar deck to the ones they're showing us. Of course, they might have more numbers because they have whole teams of analysts who can read through hundreds of pages of numbers and make decisions on that. We can't do that. We don't have full teams. So they might show us less numbers that aren't as expedient or important for us to see flat out, right? But if we want to see them, the numbers are all the same numbers are in the SEC, the Securities and Exchange Commission's database. We all have access to it. That's how public companies work. Equal information, right? Of course, how much time you have or when you see that information might be a little different, but it's all out there. If you want to see it, no one's hiding the information from you. So he's wrong about that. Institutional investors buy IPOE and they buy every other SPAC because they have to. Otherwise, the SPAC wouldn't be on the public market because that's just how SPACs work. That's just how it works. I don't know what to say on that. All right. So that's wrong. And then there's a whole pipe that's going to be put together to take this company public. There's a pipe. Who buys pipes? Institutions, right? Private investors or private investment in public equities, right? That means they're institutions buying into this deal. So 40% in IPOE plus billions of dollars more from the pipe that's going to be put in this deal means more institutional investors. So it's going to be at least 50% institution. So what he's saying is at least 50% wrong. Well, it's 100% wrong because if it's more than zero, then it's not no institutions. So he's completely wrong. Completely wrong. Completely and utterly misleading. I don't know why he would do this. I don't get it.
I don't think they're interested. So they are going to you and me via their platform, via the mass media and say,
what investor would not be interested in a company that has their name on an NFL stadium, right? They own the naming rights to the stadium that's going to host the 2021 Super Bowl, the 2022 Summer Olympics, the 2024 Summer Olympics, the WrestleMania and NCAA sports championships. That's not what that matters. But at that point, if you're that big of a company that you have your name on buildings, on NFL buildings, stadiums that millions of people see every week, what institutional investor says, that's a terrible company. I'm not putting any money in that. What sense does that make to you? Just think about it yourself, just real quick. What sense does that make to you? And he says no institutional investor wants this deal. Well, we know it's not true, but just if you reason about it for a second, or even less than a second, you'll see why it's not true. It's very simple. Let's keep watching.
Here is the greatest SPAC on earth. We could be the next Facebook. Jump in now or you'll miss out. But really, even if you think that is the case, then so much of the profit has already been taken by the guys who bought it up and pushed the price up. Because you're saying now, okay, we are at $18. That means we are 80% above where we started. So someone's taking an 80% profit here. Is it worth that much more than that 80% upside?
Who's taking the 80%? And this is a great point that Top Ev just made in the live chat. And if you have any thoughts, come in the live chat. We'll get to it. Top Ev says, do you know what I like about SPACs? You're able to get it at the same price as institutional investors. And that's right. We've talked about that so many times in this channel. That's why I am so bullish on SPACs, because retail investors get to invest in these SPACs at the net asset value, $10 per share, just like anybody else, just like the institutional investors. We get to buy in at $10 per share. So if you want to invest at the ground floor, you get to. There's no one who can say you can't buy because you're not sophisticated, you're not accredited, right? Everyone gets to buy in at $10 per share. So Felix is saying, hey, it's at 18, so it's not good. Well, fair, okay, it's at $18 now, 80% greater. But at one point it was at 10. So you're saying it's not a good deal because it's going up a little bit. Doesn't really prove a point. Yeah, the stock went up. That's what stocks do. They go up and they go down. So saying don't buy because it's going up, not a great argument, because what's your horizon, right? Are you trying to day trade it? Yeah, I mean, don't buy it today because it's already up. Are you trying to swing trade it? Well, yeah, maybe don't buy it today because it's already at the top that I think is the top. But if you're looking long term, it doesn't matter what happened today or in the last few weeks. What matters is, where do you think it's going over the next few years to a decade or 2 decades, 40 years, whatever, right? What is your horizon? What's your time horizon? Where do you think your company is going to grow to in that time? Not what is going to happen in some chart over the next few weeks or in the past few weeks. Look long term. That's how you make real wealth. If you want money, go ahead, try to day trade it. Try to swing trade it. You have a very low chance of actually succeeding in that. But if you want to try your hand at losing money, go for it. But long-term investors, that's the way to go.
Over cash. I would say not. And I'm sure a lot of you guys disagree with that. And I love people disagreeing with me. Write down below in the comments why you disagree, and we can have an actual conversation about it. If you really want to ask me a question on it, guys,
Felix, hey, I disagree with you, buddy. I'm on the show. Let's talk about it. I would love to have you. Let's do a Zoom chat or whatever we do, whatever the cool kids do these days. Let's talk about IPOE SoFi. I'm not trying to bash you. That wasn't my goal. I actually almost left a comment, or I wanted to leave a comment, and I decided not to, because here's why. I didn't want to leave a negative comment on another YouTuber's video because I know how hard it is to put out content. But this is highly misleading. What you're doing is highly misleading. And if you disagree with my take, then come on my channel. Let's talk about it. Let's talk about IPOE and defend your points. I didn't post this comment because I don't want to post negative comments. That's why I made the video instead, because I can actually produce actual reason and share that with you. And this was in the Discord channel. So if you want, you said you were open to disagreements. Come on the channel. Let's talk about it, Felix.
Go onto the Discord and we can have a real debate. I'm not somebody who thinks I'm always right. I'm very happy to be proven wrong on everything. But looking at the numbers here, looking at the margins and looking at the growth, and what I look for with a growth company, the first thing is growth. The growth is disappointing. The margin is disappointing. And the future margin in 4 or 5 years out is still disappointing. And I would expect that to be much bigger than that of an old bank, because they don't have to employ all these people. They can put their staff where it's cheaper. They can have their back.
Okay, guys. So here's my conclusion on Felix. Before the video is even over, Felix is not a growth investor. That's not what he cares about. What he cares about is how much money are you making today. That's all I care about, says Felix. I want to see what your EBITDA margins are today. JP Morgan, are they higher than SoFi's? Great. You're a better investment than SoFi. But what he doesn't actually realize or understand is that investing is for the future, right? If you're looking for money, if you want income, go get a job, right? Go get a job. You'll make lots of money that way. Much more money than trying to day trade, right? If you want income today, go get a job. Go to school, get a better degree, and get a better job. You'll make lots of money that way, instead of trying to spend all your time swing trading stocks or getting passive income from dividends. If that's what your goals are, go do that. But Felix is not a growth investor, from what I'm seeing in this video. He is so concerned with margins today. Investing is in the word invest. To vest into your future wealth. That's what the word vest means, to come into ownership, to acquire wealth, right? You vest into your future wealth. It's about the future, not today. So yes, JP Morgan might have better margins than SoFi today. You're completely right, Felix. You're completely right. I give you that. But that doesn't matter to growth investors. What matters is what SoFi can do in the future, because that's what we care about as growth investors. The word growth means over time, to become better over time, to increase, to increase over time, right? That's what growth means. Not to be the best today. So Felix is not a growth investor. If you're watching him as a growth investor, trying to take tips from him on that, hey, to each his own. And I don't know Felix that well, so maybe I'm wrong. Maybe I'm just misjudging this guy on this one video. I'm sorry for that. If I'm wrong, Felix, I hope I'm wrong about that. But from what I'm seeing, I think that's a fair assessment, right? You're focused on the now. Investors, real investors, focus on the future. The future revenues, future margins, right? Future EBITDA margins, not today's EBITDA margins, right? Growth rates. And we've seen JP Morgan's growth rates. We've seen PayPal's growth rates, right? We see that they're much lower than the IPOE so far. We've seen it. It's all right here. 13%, 9%, 8%. That's not what SoFi is doing. Let's look at the investor presentation real quick. Let's just see what SoFi says they're doing here. So if we just look at their charts, we can see it. So they're growing their adjusted EBITDA, their revenues right here. Let's look at their adjusted net revenues. They had 87% year-over-year growth in 2019. In 2020, they did 38%. In 2021, they expect to do 58%. And he says 16%. He said it was 16% multiple times. I gave him benefit of the doubt, and he kept saying it. 16%. 16% is not 58%. 58% is what? 3 times greater than 58%? He had it completely wrong. Remember, 58% for 2021 is what they're going to do. And they're on track to do that. PayPal did 18% in 2018, 15% in 2019, and 20.7% in 2020. JP Morgan and Chase did 13% in 2018, 9% in 2019, and 8.9%, let's just say 9% in 2020. Let me just ask you, is 58% greater or less than 9? If you guessed 58, you graduated first grade. Congratulations. In 2022, they expect to do 53%, 40% next year, 33%, 31%. So they expect to start tapering off. So they're going to continue to grow or invest aggressively in their growth between now and 2023. They expect to have up to 40% in revenue growth between now and 2023. And then guess what? They're going to say, hey, we have enough growth now. We're making, what is this? What year is this? $788 million in adjusted EBITDA profits, right? You want profits? Here's your profits, right? 2024, 788. 2025, they expect to do 45% margins. That's more than what JP Morgan Chase is doing right now. They're doing 44%, right? You say you want EBITDA margins? Well, 2025, that's your year, Felix. Wait for 2025. 2025, SoFi will give you 45% margins. So if that's what you want, then come back in 2025 when we can talk. But today, if you're a smart investor and you see this graph and you see this, you see what they did here, you see this, they were in the negative $227 million in net losses, right? Profit losses, right? They were losing that much in 2018. And now in 2020, they were losing $66 million. That's a huge improvement. So I trust them to make this $27 million in positive profits this year, adjusted EBITDA profits. And then I trust them to make $1 billion in 2025. And so if I'm a smart investor and I trust them based on what they've done in the past, and I trust them to do what they said they're going to do in the future, then I will be very happy to buy them today and invest into my future wealth once they reach this $1.1 billion in adjusted EBITDA profits. And then what happens next? They go to 4 billion, and then they go to 5 billion and 10 billion and so forth. And I keep holding and I keep building my net worth, right? By buying and holding. So if I'm a smart investor, if I want growth, if I'm investing for growth, I am extremely happy to have the privilege, to have the opportunity to invest today. I get to invest here, and then I get a benefit from this, all of this, right? That's what you want, the hockey stick. As an investor, you want the hockey stick. If I get that, why wouldn't I take that over someone who is saying that they're growing by 20% and 10%? Why would I not take that? The reason I want to take that is because I'm not focused on growth. I'm focused on selling courses and justifying that based on JP Morgan's EBITDA margins today, because I don't care for growth. And my name is Felix. So let me just read some quick live chat comments real quick. We got 2 more. And before we get to that, if you enjoyed the video, don't forget to like it, subscribe to the channel, hit the notification bell, comment your thoughts, and let me know if I'm being too harsh. Let me know if I'm being reasonable. Let me know what your thoughts are on IPOE SoFi. Let me know what your thoughts are on what Felix is saying, because I can't just sit by and let this. My subscribers are watching this and they're believing it, and I don't want that, right? So I have to protect my subscribers, right? And if you're new here, we practice the bull mentality on this channel. The bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hope for the long term, because that's how we give ourselves the best chance of success on the stock market, right? That's how we build long-term wealth in this country. So yeah, that's why I'm making this video. So if you enjoy, don't forget to like. And you can join us over at patreon.bullacademy.org to engage in our Discord channel. So let me just read 2 comments and we can finish the video. I keep saying that. We'll get to it. We're almost there. We're so close. Okay. So Tyler says, I thought I was losing my mind when he said 16% revenue growth. Thanks for clearing that up. Of course, Tyler. I don't know where he got that 16% from, because it wasn't even the numbers that he was looking at. 2020 versus LT on last 12 months. That wasn't even correct. That was 20%, right? So I don't know where he got 16% from. And that was also the wrong number to be looking at. And then Robert says, I think the guy he is criticizing is me. And I think he's talking about when I was saying about swing trading and day trading. I'm not trying to criticize anyone. I'm just saying that's a different way of investing. You can do that if you want to. I don't really care. But on this channel, we focus on the long term. So Robert Frank says, I bought for $10.50 and I sold for $29.86. Swing trading IPOE. But what does that matter to long-term investors? All they need to be concerned about is cash flows. And Robert's completely correct. Can your company one day grow to be able to cash flow positive and sustain that? Well, in order to get there, you have to grow. You can't just wake up and be cash flow positive, right? Of course you can, but you won't get too far. You will just be making a little bit of money, and no one's going to invest in that. So you have to invest in the growth, right? You have to spend money today to build membership by 273%, to build your financial services, right? Increase lifetime value of your customers, decrease customer acquisition costs, be able to sell your loan, your mortgage product to 65% of your customers for free. No marketing, because you already have them in your platform. That's why SoFi is special. And then you get a bank charter in the future, decrease your cost of doing business because you don't have to go through a middleman anymore. You don't have to go through some other bank. You get to just directly communicate with your customers and transact with them because you're a bank now. That's what SoFi plans to do. They're buying a bank today as we speak. They're finishing that. They're going through that deal right now, right? So they're working towards that. So these numbers we're looking at, they're going to be even better in the future. So if you invest today in that and you know that, you get a benefit from that, right? Because you knew. So that's why. And then you have a Galileo, infrastructure of other fintech companies. Robinhood uses them. Revolut uses them. Moneyline uses them. Chime uses them. Right? Everyone is using Galileo. Well, not everyone, but they're growing their accounts by what? 60% or whatever. And in 2020, 9 out of 10 online neobank accounts went through Galileo. 9 out of 10. So that's a company I would like to invest in. Let me just read one more comment from Robert. Robert says, but if the sellers believe nonsense, then they are not practicing the bull mentality. They need to know what they invest in and read the filings for themselves. Don't trust other people. That's fair. If you believe what Felix is saying, I think that you can be misled. We can all be misled. So it's fair. But you have to then do your own research. Don't just take what he says and run with it. Don't just take what he says and sell all your stocks because some guy on YouTube said something. And don't just buy some company because some guy on YouTube named Lincoln W. Daniel said to buy it or because he said he likes it, right? I don't know everything. All I do is read stuff and then share my thoughts on them. You can do the same. You can read stuff too. And if you agree with what I say, then great. If I corroborate what you believe, then great. We think similarly and we can collaborate. That's what we do in our Discord channel at patreon.boardacademy.org. But let's finish what Felix is saying here. We're almost there. Almost there. Thanks for staying with me. I noticed we've been here for a while. Let's keep going.
Offices somewhere where it's cheaper. They don't have to have branches and office towers in the city, center of Manhattan and all those things. So therefore, with AI and software, you would think that their margins would be like double, triple those of the old banks, and they are not. So for that reason, guys, I'm out, basically. So it isn't one for me, but it doesn't mean it's not going to be an interesting one. But I've covered quite a few IPOs over the last few months. Coupang, for example, was another one. Was very hyped. I looked at the numbers and I also thought this is not really a good deal. So not every IPO is great. And this isn't a traditional IPO. And that's the other thing to bear in mind with SPACs or with direct placements. The process is different. The requirements are different. Who sets the price is different. Who's selling out is different. All of that is something that's super important to understand if you're investing. And again, for that, guys, I explain all of that in my Master Stocks course. So check that. The link is...
You don't need a course to understand SPACs. You want to know why? Because guess what? Bull Academy has done that. What is a SPAC on Google? You don't need to watch any what's it called? Any course. We have done that. Let's just do Bull Lincoln W. Daniel. I think that will show up. So we've done all these videos on SPACs. Right, special purpose acquisition companies explained, crash course on SPACs in 4 minutes. If you don't know what a SPAC is, we have so many videos. And you want to know what a warrant is? What is a stock warrant? And that's the answer, right? We've done all this stuff. We're top video on stock warrants. If you don't know what a stock warrant is, we've covered that, and that's an important part of investing in SPACs, right? If you want to invest in SPACs, you can do it by investing in the common shares or the warrants, right? You can leverage your money by investing in the warrants. So if you don't know what a warrant is, we have the top video on Google right here. I just Googled it in incognito. You should go watch that. It's 11 minutes long. That's all it is. You don't need to buy a course for that, right? It's free information. And I'm not the only one who's put out free information. It's all here. I researched this before I made the video. So if you don't know what this stuff is, just go Google it, right? Yeah, you don't need a course for any of this. It's all free information. And I'm not trying to knock Felix for his course. I want people to make their money how they make their money. But the reason I'm even mentioning that is because I think the reason he made his video with so many flaws is because he's just trying to sell a course, just get videos out to upsell his viewers. And I don't like that. If you're going to upsell, at least provide valuable information before you do it. Don't just put out anything, right? So that's my thoughts.
Is below, and as I say, here it is. Here I am on the screen twice, which is a little bit too much, isn't it? And I invest. So and how 95, which is money.
I think that's all.
That's what I'm doing, guys. And thank you very much for watching. Thanks for very much for watching. why, if you were a customer of SoFi, let me know. I tried to sign up, but I'm not US.
Okay, so that's it. That's pretty much it. He's just signing off. He's just signing off here. So again, my neck is hurting. We've been here for 2 hours now. Thank you all for staying here with me. It's been 2 hours and 5 minutes. I haven't had dinner yet, but I appreciate you all for staying here and watching this and engaging in the live chat and liking the video. I appreciate it all. I hope that this has been helpful to whoever has seen this video by Felix and friends and got confused about the numbers he was putting out there, because it didn't make any sense to me when I saw it. And one of my patrons sent it to me in the Discord channel. And I told him, hey, I'll take a look for you. And when I did, and when other patrons saw it, they were all confused too. And he didn't even mention Galileo. So all of this, right? This is a B. He asked, hey, what's your thoughts? And Tom and Tomer and Elliot, they all chimed in. And then I started watching, and because I was just like, what's going on here? What is he saying here? I just gave him a play-by-play of what I was thinking when I was watching this. And I try to find some meaningful argument against SoFi in his assessment, and I just couldn't find anything. So this is the value of being a patron. I wasn't going to make this video until I saw that comment from one of his viewers. And I was like, okay, this is bad, right? This comment is bad. This is what people are seeing and doing. They just watch someone on YouTube and then sell their stocks, even if they don't know what they're saying. And I think someone from, I think Tyler from our video went and commented on his video 23 minutes ago. So yeah, I don't know how he's getting that number, Tyler. But yeah, and just comparing SoFi to JP Morgan and PayPal, you could have found much better comparisons, like Upstart or Chime or whoever, someone in the actual space, right? But be nice, guys. Malik says, "Oh my God, you're terrible." Yeah, but I don't want you guys to bully Felix, but you can definitely go on and express your disagreements respectfully. Not saying that Malik's being disrespectful. I understand. I'm a little frustrated too by this, but hey, Felix he's a creator, and it's tough to make content and always get it right. And I've made mistakes too. But what I will never do, I will never make a mistake knowingly and then publish that to all of you. It's just not fair. Because we all say everyone should do their own research, but not everyone has the time to do their own research, and people depend on other people to decide on what they're going to do. So that's just being realistic. That's just being practical, right? People are going to rely on other people that they think are credible. And Felix has 20,000 subscribers, so that's some bit of credibility, and he has a responsibility to be true to them and give the right information to them. So yeah, I have my own thoughts on SoFi. I have a video that I'm planning to put out this week on what I think the biggest risk to SoFi is. And I'm going to talk about that. Of course, I'm going to tell my patrons first and share my thoughts on that before I make the video, because it's easier to just put out a quick memo to them. But if you're interested in that, subscribe to the channel, hit the notification bell, comment your thoughts, and like the video. Don't forget to like this video so I can know that you guys enjoy the videos that I'm putting out, and keep doing it. So I hope you all enjoyed it. I have a headache. My neck is hurting because I've been at this for 2 hours now. But let's just sign off. And if you want to support the channel financially, join us over at patreon.boardacademy.org, and you'll get to engage, share, be a producer of the channel, right? This video, I did this live stream because one of our patrons shared this video with me. That's my thoughts. So that's the value of being a patron. You get to collaborate with everyone and share your thoughts and collaborate and find new deals and rumors and all of that, and get in and share ideas to make the best investment decisions together. So I'm obviously exhausted because I can barely talk anymore. So I'm going to sign off. Thank you again for being here. I hope you enjoyed it. And if you did, I would love to see you over in the Discord channel. I'm Lincoln with boardacademy.org. Thank you again, and have a great night. Oh, before we sign off, one more thing. Evan says, I just realized something. Comparing small fish SoFi to JP Morgan Chase itself is a victory. That's true. Good comparison. Thank you, guys. Thank you, Evan, for that last comment. Appreciate you all. Have a great night.